Hi, are you a limited company director and wondering the best way to pay yourself? You're not alone. I'm Dora from Grace Certified Accountants, and in this video, I'm breaking down the difference between PAYE and dividends and how directors can pay themselves in the most tax efficient way. Now, before we dive in, please remember to subscribe, like, and also hit the bell button for more tax tips, accounting, and business advice. So, what is the difference between PAYE versus dividends? Now, let's define the two main ways you can pay yourself as a limited company director. PAYE, or pay as you earn, this is when you pay yourself a salary through your company's payroll system. So you're treated as an employee. Your salary is subject to income tax and national insurance, both employee and employer portions. Now let's look at dividends. Dividends are payments that are made to shareholders on the company's post-tax profits. So that means after tax has been paid, the profits that remain, a portion of that or all of the profits can be paid to the shareholders of that company. With dividends, there's no national insurance that is paid, and the tax is at a lower rate compared to income tax. In order to receive dividends, you must be a shareholder of that company, and the company must have made profits in order for you to get dividends from the company. Now let's look at the pros and cons of PAYE versus dividends. 1. Tax. So PAYE or salary is taxed. You pay national insurance and you pay income tax. However, on dividends, these are paid post-tax profits. So they are paid on profits after having paid tax. And they are usually taxed at dividend rates, which are lower than the income tax rates. Secondly, predictability. So your salary is seen as regular income. However, your dividends, these are paid as and when the profits allow. Thirdly, you have your qualifying pension. So salary, yes, it qualifies for pension. However, dividends do not qualify for pension contributions. And then you have mortgage friendly. Which one is mortgage friendly? With your salary, it's seen as regular income and preferred by lenders. However, with dividends, this is seen as less predictable and less preferred. So when you're applying for your mortgage, if you're able to show a salary, a pay slip, then that is actually preferred, and it's seen because it's seen as regular income. Whereas if you just show that you're director of a limited company earning dividends, these are seen as less predictable because it's only they are only available when profits allow. And the final comparison is tax deductible. With your salary, yes, it reduces corporation tax, meaning your salary that you get from your company is actually seen as a business expense, and it reduces your corporation tax for the company. However, with dividends, these are paid out of post-tax profits. So after your corporation tax has been paid, whatever remains as profit, that is what you get your payments as dividends from. So these are not tax deductible. They're actually post-tax payment. And that is the comparison between PAYE and dividends. Let's jump on to the next section. And another thing to bear in mind is that salary reduces corporation tax, whereas your dividends, they are tax efficient when for personal income. So when you're looking at the most amount of money to get as a director from your business in terms of personal income, then dividends are more tax efficient. So let's look at what is the best mix. Well, the best mix is actually getting salary and dividends. So in 2025-26, this current tax year, you get salary at the level of personal allowance, which is at 12,570, and then get the remainder in dividends so that you cover the basic rate tax band. Let me show you an example. So let's look at this example. If you take salary at 12,570 and then take the remaining 37,700 as dividends. So what you're trying to do is that your salary covers the personal allowance, which you don't pay tax on, and then the remainder, the 37,700, you take that in dividends. Remember that £500 is tax-free in dividends. So the first £500 that you take in dividends is tax-free. So what will happen is that you don't pay tax on your salary, 12,570, and then you don't pay the 37,700 that you take. You don't pay any tax on the first 500, but then the balance, the 37,200, is what you pay tax on. But then you pay this tax, is dividend tax, which is 8.75%. So this is way cheaper and more tax efficient when you take more dividends in comparison to taking income tax, because income tax or salary, because you pay salary on income tax. So income tax on salary is 20% compared to getting 37,000, just over 37,000 as dividends, which you only pay tax at 8.75%. So looking at this combo, it helps you to reduce your corporation tax, and it also helps you to pay tax at a lower rate. So meaning you get more money in your pocket, but then at the end of the day you pay less tax. Now let's look at the key considerations and mistakes to avoid. 1. Don't take any dividends if there are no profits, or if the profits are low. 2. Always leave funds for corporation tax. 3. Use a proper payroll system. Don't DIY it. 4. Review your tax band before deciding your pay mix. So first of all, review your tax band before deciding your pay mix. So how much are you going to get in dividends? How much are you going to get in salary? First of all, review your tax band. And other things to consider is, do you need pay slips in case you're thinking of making a mortgage application or loan application? So you might want to think of salary, meaning, show a good salary on the pay slip. And secondly, another thing to consider is, are you thinking of long-term planning? So contributing into a pension. So if you're thinking of contributing into a pension, again, think along those lines, and then you should think along the lines of salary. Remember, smart director pay or planning isn't just about now. It's also about setting yourself up for the future. So don't think about just now or the current tax year, but it's also about setting yourself up for the future. So think in terms of retirement, have a retirement plan in place. Think about investment. So maybe you want to grow your business, you want to expand. Think also in terms of business reinvestments. What are you going to do in terms of business reinvestment? So smart director pay is not just about now, but it's also about planning for the future, for when the business grows, for when you want to retire, what is going to happen when you have enough funds. Remember, structure your pay in a way that supports long-term growth and also keeps your finances clean and compliant. You don't want anything, that will annoy the taxman. So, PAYE versus dividends. Well, a mix is usually the best, but how much is dependent on your business and your goals. So, do you need help structuring your ideal pay? Well, I'm here if you want to have a chat. Feel free to reach out. Also, remember to subscribe, like, and share our video if you found this useful. And we have more tax tips and advice on our website, www.gracecertifiedaccountants.co.uk. Or if you have any questions, feel free to drop it in the comments, and I'll be happy to have a conversation with you. Have a great day, and thanks for watching. I'll see you again soon.